All right, let's talk about Chapter 8, where we'll be accounting for long-term assets. So I've got to make it go. So we'll get into the cost determination in just a second. Let's talk about what plant assets are. When we're talking about plant assets, we're thinking about the big things that a company buys or the big things that a company owns, like buildings, property, machines, right? So they're tangible in nature. They're things that are going to be actively used in operations. They have to be actively used in operations. They are expected to benefit future periods. That's a very important concept to think about because we are making a purchase, right? That's a cost. That's money that normally goes out that's going to last into many, many periods into the future. And if we think about the matching principle, what happens? We have to allocate cost into the same period in which those costs benefit revenue. So that's why that's important. We call plant assets property, plant, and equipment. Property is real estate, plant, buildings, equipment, machinery, vehicles, things like that. What happens to plant assets over time? Think of this building. Look at it on the left. It's new, it's fresh, everything looks good. But as time goes on, it starts to look a little bit more worn and a little bit more run down as it would be. So certainly, plant assets are going to decrease in value over their life just because of normal wear and tear and attrition. So we have to consider that, and that's what we look at it from a monetary standpoint. Of course, it devalues over time. How do we record plant assets in our books? First, we have to think about the acquisition. We have to compute the cost. We'll get into that in a second. While we're using the asset, we need to allocate its cost over its periods benefited. That's the matching principle. We're going to take that cost and push it into those revenue periods. And then we account for any subsequent expenditures because eventually you're going to have to do something. You're going to have to make some major repairs or something. And then at the end of the asset's useful life, we'll end up recording a disposal. Let's talk about cost determination. What makes up this cost? Well, whatever we pay for it, that's the purchase price. Anything that we have to spend to get it ready for its intended use, and that acquisition will exclude any finance charges and cash discounts. Let's look at a couple different types. If we're talking about machinery and equipment, it's going to be the purchase price. Any taxes that we had to pay, like sales taxes. If we had to pay to get it here, transportation charges. If we had to pay for insurance while it was on the train. If we had to pay for someone to install it or assemble it or test it. All of those are a part of the acquisition cost of machinery and equipment. If we're talking about buildings, it's the cost of purchase or construction. Any attorney or title fees that we have to pay, any taxes that we need to pay to clear title on it, any brokerage fees, all go into the cost of a building. What about land improvements? What are they? Not the land itself, but things that we can make appurtenant to the land. Parking lots, driveways, fences, walkways, shrubs, lighting systems. Obviously, those things get attached to land, and we can depreciate them over their useful life as well. What about the cost of land? A few things going on here too. The purchase price, obviously, any commissions we pay for the purchase, any title insurance. If there were any delinquent taxes on the land, that has to be made up at the county. Surveying fees that happen, any title search and transfer fees. All of that goes into the cost of the land, but I want you to notice down there that land is not depreciable. Land is never depreciable. It is always considered to be an appreciable asset, meaning that it usually goes up in value, not down. Land does not devalue, and do not mix that fact up with depletion of a natural resource. We'll talk about that in a second as well. All right, so how do we write off the cost of land? And that's where we get into depreciation. But before we even get that far, we need to understand that when we purchase assets, sometimes we can just end up making a lump sum purchase and buy several assets at one time. And we may have a hard time determining what value to apply to the different classes of assets that we've purchased. Let's take a look at this example. I think will explain a little bit better. It says CarMax paid $90,000 in cash to acquire a group of items consisting of land which was appraised at 30, land improvements appraised at 10, and a building appraised at 60. and the 90,000 needs to be allocated. So look at what's happening here. Here's the appraised value. We paid 90,000, and the truth of the matter is, how do I split the $90,000 up between land improvements and building? So we ended up getting an appraisal, and we found that these values are attributable to those three things, but that totals 100,000. So all we need to do to allocate this lump sum purchase is to find the percent of the total. 30,000 of 100,000 is 30%. 10 of 100,000 is 10%. 60 of 100 is 60%. So you'll see that we've just found the percentage of each one of these things. And then when I multiply that percentage by the 90,000 lump sum purchase, 30% times 90,000 gives me a 27,000 allocable or apportioned cost. 10% of 90,000 gives me 9. 60% of 90,000 gives me 54,000. Therefore, these are the amounts that I'm going to allocate to each of my three assets. So, depreciation, again, it's the process of allocating or writing off the cost of a plant asset into an expense account to the accounting period benefiting from its use. Remember, the matching principle says that we must have expenses in the appropriate period in which they benefit revenues. Well, if I've bought a $60,000 building that's going to last me for 5 years, I need to spread that $60,000 cost into expense over 5 years. That's what this cost allocation is all about. So when we first purchase property, plant, and equipment, we put it on the balance sheet. And then when we allocate that cost out, we move a piece of that cost over to the income statement. So it devalues here on the balance sheet, and it goes on the income statement as an expense as it gets used up. A few factors we have to think about in computing depreciation. Basically, three amounts that we'll always need is the cost, the salvage value, and the useful life. So let's look at these three different types of depreciation methods. Are there other methods? Absolutely, there are other methods, but we'll just focus on these three for today. So we're going to use this example, and we'll explain these pieces and parts as we go. In this example, cost is going to be 10,000, a salvage value of 1,000, leaving me with a depreciable cost of 9. We're going to depreciate it over 5 years, and this machine that we're purchasing, we believe, will inspect 36,000 shoes. That's the information we need to look at all three of these. The straight line method is going to take the cost minus the salvage value over the useful life in periods. That's what the formula is. Cost minus salvage value over its useful life. So what are we talking about here? Well, we understand cost. We've already talked about what cost is. But what's salvage value? Salvage value is the number that we believe this is going to still be worth even after we have fully depreciated it. After we've completely used it up, it's still going to be worth $1,000. Think about if this were a used vehicle that we bought. We would be saying that we buy this vehicle for $10,000 and we're going to use it up for 5 years. Is it going to be really worth nothing at the end of 5 years? I mean, even if it's not running anymore, I can probably take it to the scrapyard and get something for it. That's what salvage value really is. So in the formula, we take the 10,000 minus the 1,000. That gives us 9,000. We divide that by 5 years, and it says that we need to allocate $1,800 of the $10,000 cost out per year. How do we do that? We book the $1,800. This is a 1 year entry. Can you do it monthly? Sure you can. How many businesses do it annually versus monthly? I think it's kind of a mix. I think it's probably about half and half, at least for my client base. So depreciation expense gets the $1,800, and then we put the credit to this new account called accumulated depreciation, and we classify what it's for. We put the credit there. That accumulated depreciation is going to be a contra account. You'll see what it does in the balance sheet presentation. I booked the 10,000 in a machinery account, and I'm going to leave it there. But then I'm going to put all of that depreciation as a negative on the balance sheet. That makes it a contra asset account so that we get a net value for our machinery. At the end of 5 years, if we had no salvage value, this number would be 0. But our salvage value was what, 1,000? So at the end of 5 years, this value should end up being 1,000, and it'll stay there until we end up selling that asset. See what's happened? The depreciation expense has been the exact same amount every single year, but then the book value on the balance sheet has declined by $1,800 every year until it gets down to the salvage value of $1,000, and that's where it stays. Here's what it looks like in a depreciation schedule. I think this is a little bit easier to see. We start with 10,000. Obviously, our depreciable cost is 9,000. Notice that they've decided to use a depreciation rate here. Really hadn't talked about that yet. But obviously, if you look at the formula, the cost minus salvage value over useful life, if you take 1 over the useful life, you'll get a rate. Because it's a fraction, you can find a rate. So if you always take 1 divided by the useful life, you'll get this rate. And you can use that in a straight line. 9,000 times 20% is 1,800. It's the same thing as 10,000 minus 1,000 divided by 5 years, right? That gives us our depreciation expense. We now, in 2015, have accumulated depreciation of 1,800. So our book value is now dropped to 8,200. 10,000 minus the accumulated depreciation gives us our book value. In year 2, we take the 9,000 times 20%, another 1,800 of depreciation expense. So our accumulated depreciation is now 1,800 plus 1,800, which gives us 3,600. We take 10,000 minus 3,600, we now have 6,400. We just kind of keep that going all the way down until we get to the end of year 5, and we still have that salvage value on the books, and it does not get depreciated. It will stay there. What if I own this machine until 2025, which is quite a ways after? It's going to stay on the books at $1,000 until the day I get rid of it. What about the units of production method? This one's a little bit different. We see this a lot in manufacturing, in machinery. So there's a 2-step process to this. First, we have to calculate our depreciation per unit. It's kind of the same formula. We take our cost minus our salvage value, but instead of dividing it by useful life, a number of years, we divide it by our expected units of production. How many do we think we can run through this machine before it's over, right? And once we get this depreciation per unit, once we know our actual number of units produced in any given period, we multiply it by that rate to get what our depreciation expense is for the period. Let's take a look at that. Remember, this was our data. We have 9,000 depreciable cost, but we have a units inspected at 36,000 shoes. We believe that this machine will inspect 36,000 shoes, and then in our mind, it's just going to die, although it probably won't. How do we calculate that? We take the 9,000 divided by the 36,000 shoes, and we say for every shoe that comes through this machine, we should depreciate 25 cents. So we look at our actual period. So what happens is, assume that 7,000 units were inspected in the first year. We take the 7,000 times that depreciation per unit. Our depreciation expense in year 1 will be 1,750. Depreciation is always going to end up being a little bit different depending on how many units are inspected each year until you get to the total value. You can't go more than 36,000. Here's what it looks like in a schedule. Again, here's the number of units that were inspected each year. You'll see we just multiply it by the depreciation per unit to get our expense, but we will not let it go past 1,000. We have to leave it here. So whatever it takes in this final period to get us to a salvage value of 1,000, we just plug this number regardless of how many units were actually inspected. All right, and then finally we have the double declining balance method. And this one allows us to take more depreciation at the beginning of an asset's life and less depreciation at the end of an asset's life. The thought process there is that when a machine is brand new, it probably has a higher production level. Therefore, we have higher revenues. So we should have a higher depreciation expense in those earlier years to match up with those larger revenues, and just the opposite in those later years. The machine is not producing as much, it's not operating as fast, so the revenues are going to be lower as a result. So that's the theory behind the double declining balance method. 3 steps to this one, right? It gets just a little bit more complicated. The same piece of data. First, we have to know that straight line rate. Remember what it is? 1 divided by 5. This says 100% divided by useful life, but isn't 100% just 1, right? 1 divided by 5, and that will give us our percentage. And then we have to find our double declining balance rate. Well, that's simple. It's just 2 times, that's the double, 2 times the straight line rate. So if the straight line rate is 20%, then the double declining balance rate is going to be 40%. Okay? Then what do? To find our depreciation expense, we're going to take our double declining balance rate and we're going to multiply that by our beginning of period book value. And that's the piece that feels a little weird. We're not always going to take 10,000 or 9,000 times 40%. You wouldn't get far, right? Without a doubt. It's always going to be the beginning period book value. Let's look at it in the chart because it's easier to see. So if I started with 10,000, by the way, I do this all regardless of salvage value until I get to the end. Notice I'm not starting with 9,000. I'm starting with 10. So I take this 10,000, it's period 1. I multiply it by the 40%. That gives me a depreciation of 4,000. Now my accumulated depreciation obviously is also 4,000. My book value is 6. 10 minus 4 is 6. Here's where it's different. When I start period 2, I take this ending book value and make it my beginning book value for 2016, which makes sense. Then I multiply that by the 40% for a new depreciation expense of $2,400. I now have accumulated depreciation of 64. 4 plus 24 is 6,400. My book value is now 10,000 minus 6,400 to give me 3,600, and then we just repeat and recycle, right? We just kind of keep it going all the way down. Remember, obviously, 1,296 times 40% is not 296. That's why we have an asterisk here. It's because I can't go more than 296 because I've got to make this equal to the salvage value. It has to come out here to be 1,000. Notice how I have higher depreciation in the earlier years and much lower depreciation in the later years, but at the end of the day, total depreciation expense still comes out to be 9,000. That's always going to be that way. Look at this. If I see all 3 methods over the 5-year period, it's exactly the same. I still come out over 5 periods to 9,000 of accumulated depreciation, leaving a $1,000 salvage value on the books. You'll see down there at the bottom, methods used by companies. About 85% of all companies use straight line. There's a good reason for that. Number 1, straight line is generally accepted accounting principles. That's what it says that we're supposed to use for GAAP is straight line. Others use the units of production 5%, declining balance 4%. That's a departure from GAAP, right? But we can disclose that. We can certainly have a departure from GAAP. Number 1, if it's not material, and of course, if the cost outweighs the benefit, so we have those constraints that we can use to use those other methods. All right, depreciation for tax reporting. This is probably why I think that that last chart was a little bit wrong, because the IRS requires that we use an accelerated cost recovery system called MAKRS. And it used to be, first it was GDS for General Depreciation System, and then it was ADS for the Alternative Depreciation System, and then we went into a recession and they came out with ACRS, which was the Accelerated Cost Recovery System, and then we had another recession and they came out with MAKRS, which is a modified Accelerated Cost Recovery System. Welcome to the world of tax, right? MAKRS depreciation really provides for a faster write-off. It really, for most assets, works just like double declining balance. So there are certain classes of assets like machinery and equipment, office furniture, vehicles, that allows us to use double declining balance for taxes, so we get a bigger expense in the front. And that incentivizes people to make new investments, or businesses to make new investments. Certain classes of assets, though, still have to be written off straight line. What about partial year depreciation? How do we deal with that? So obviously, you're not going to go out and buy all your assets on January 1 to make it easy, right? It just doesn't work that way. You're going to buy assets throughout the year. And when it's acquired during the year, we have to calculate the depreciation as a fraction of the year. So it looks like we have the same example, 10,000 minus 1,000, 5 years, 36,000 units. But let's assume that we purchased it on October 8th of 2014. How do we calculate that? We're still going to do the same calculation here, but we're just going to multiply it by the fraction of the year. October, November, December gives us 3 months over 12. We're not going to worry about the 8 days, right? It's at the beginning of October. If this were at the beginning of October, we might only take 2 out of 12. So you have a little bit of wiggle room in there. I think if you wanted to get it down to the days, you could, but I think the cost outweighs the benefit of trying to do so. What about changes in our estimates? What if we determined that 5 years wasn't long enough? Or what if we determined $1,000 salvage value was too much? Right? So can we change those things? And absolutely we can. So over the life of an asset, new information obviously may come into play, which makes you want to change that original estimate. Here's what we look at. If we look at our machinery from that previous example, we assume that at the beginning of the asset's 3rd year, its book value of $6,400. That makes sense, right? Because remember, it was $1,800 in depreciation per year. So for 3 years, that's $3,600. So $6,400 is our $10,000 minus $3,600. At that time, it's determined that the machinery will actually have a remaining useful life of 4 years. Well, we've already gone 3. We're saying it's actually going to have a total useful life of 7, and that the estimated salvage value we should revise from $1,000 to $400. How do we deal with it? It's really quite simple. People get so hung up on this. At the time you decide to change your estimate, you take the current book value. That's easy, 10,000 minus 3,600, minus our new salvage value and divided by our remaining useful life. And for the remaining 4 years, we simply depreciate $1,500 per year. All right, reporting depreciation. You'll see that typically when we report it, we list it by its different class. We've got race vehicles, then we've got furniture, software, and equipment. We've got shop and track equipment. So we typically do go and classify that some kind of way, categorically. Then you'll see that we have our total property and equipment. Then we take out our accumulated depreciation to give us a net value. What about additional expenditures? Do you think you ever have to do anything to an asset to keep it going? Let's say it's a building. What if you need to replace the carpets, or you need to paint the whole thing, or maybe you need to replace the roof? You have to ask yourself a question. Is what I'm doing an expense that I can just expense off right now? Or is it something that I need to capitalize, which means I need to put it on the balance sheet and depreciate it over time because it gives me enough of a future benefit? Notice there in the pink box at the bottom, if the amounts involved are not material, this is the materiality constraint, most companies will just expense the item. So if it's not going to make a difference to a reader, just expense it. If it's a $200 deal on a $200,000 building, expense it. It's not material, right? So here's how we kind of put this into a chart to figure it out. If we believe it's ordinary repairs, then we should just expense it. That's what capital or revenue means, and it says revenue. It means that we're going to expense it against revenue. If it's an ordinary repair, we're just going to push it to repairs and maintenance expense. An ordinary repair is anything that maintains normal operating condition, does not increase productivity, and does not extend life beyond the original estimate. Well, folks, I think that things like painting walls inside of a house and replacing carpet in a house falls under ordinary repairs. It just keeps it going as it should be. It doesn't increase its use at all. I mean, it's just paint and carpet. And it doesn't extend the life at all, right? It's just a repair. Betterments and extraordinary repairs are different. Number one, we have to depreciate those things. We've got to put them on the balance sheet and figure out a class life and depreciate it over time. What types of things are we talking about? Major overhauls or partial replacements. Extends life beyond the original estimate. What are we talking about here? A new roof on a building certainly is a betterment or an extraordinary repair. It extends the life. If I don't replace the roof, the building is gone. If I add a new room on or a wing onto a building, that's a major overhaul or partial replacement. That's a betterment and extraordinary repair, and it has to be capitalized. All right, how do we get rid of plant assets? Because obviously you may not have depreciated it all the way down to the end. Maybe you have, but at some point you're going to sell them or you're going to throw them in the trash. You're going to do something. You need to get it off the books because you still have that piece of equipment sitting on the books. You still have the accumulated depreciation sitting on the books, which means you still have the salvage value on the books as well, or any undepreciated value still sitting on the books. So in order to dispose of plant assets, the first thing that we do is we update the depreciation to the date of disposal. So if we haven't recorded the depreciation in the current period, and it's currently, I don't know, July, we're going to make a journal entry to bring the depreciation up for, 7 months of the year. Then we journalize the disposal by first recording any cash that we received or any cash that we paid, because sometimes you actually have to pay to get rid of stuff. Might have to have somebody haul it away, right? So the first thing you do is record the cash because it's the easy part. It's the known part. Then you remove the accumulated depreciation from the books for this particular asset. Whatever you have for accumulated depreciation for this asset, you take it off the books. Well, it went on as a credit. It's got to come off as a debit. Then you've got to remove the asset cost from the book. So if you initially paid $10,000 for it, you take the $10,000 off the books, right? It went on as a debit, you take it off now as a credit. And most likely, dealing with this block now, 9 times out of 10, probably 90, actually more than that, 99 times out of 100, your accumulated depreciation less your asset cost is going to be a different balance than your cash. So you need a plug number, right? You're either going to need a credit or you're going to need a debit to make the journal entry balance. And the rules are, if that plug number is a credit, then you have a gain. And if it's a debit, you have a loss. And that kind of makes sense because aren't revenues credits and aren't expenses debits? So that kind of works here, right? So if your plug number is going to be a credit, it's a gain. If it's a debit, it's a loss, and you're done. You've disposed of it. And that's exactly how we work it. That is the prime example of backing into a number. But if you wanted to have the knowledge of it, to understand this, if your cash is greater than your book value, right? What's book value again? It's the asset less any accumulated depreciation. That's what book value is. So if your cash is bigger than your book value, you've got a gain. That makes sense. It means I sold it for more than what it's worth on my books. It means the gain is going to be a credit too. Cash is less than book value, it's a loss. And if they're equal, there's no gain or loss. Here's the example. Machine cost $9,000 with accumulated depreciation of $9,000. All right, so what's its book value? It's 0, right? It has a book value of 0. If it costs $9,000 and it has accumulated depreciation of $9,000, it's worth nothing on my books. It was discarded on June 5th of the current year. The company is depreciating the equipment using the straight line method over 8 years with a 0 salvage value. Okay? And basically it's saying we're just going to get it off the books. We're going to discard it. We're going to throw it in the trash. That's what this is. It has no book value on the books at all. So we simply need to take the accumulated depreciation off the books with a debit and take the machine itself off the books with a credit. And we're done. That's simple. Here's a different one. Equipment costing $8,000 with accumulated depreciation of $6,000. What's the book value? Book value is $2,000, right? On December 31st, of the previous year was discarded on July 1 of the current year. Discarded means I threw it in the trash, folks. I didn't get any money, so you got to think about it that way. The company is depreciating the equipment using the straight line method over 8 years with 0 salvage value. It had nothing, right? So the first thing we need to do is bring the depreciation up to date. It's currently July 1, so 6 months have happened. We need to go ahead and record 6 months worth of depreciation. The depreciation annually was $1,000. We take half the year. That makes the depreciation $500. Notice that now is going to make my accumulated depreciation $6,500, right? So now I have a cost of $8,000 and accumulated depreciation of $6,500. Now I've got to get it off the books. I take the depreciation off with a debit. I take the equipment off with a credit. And then I need a debit in order to make it balance. I plug the $1,500 debit in, and the rules say if it's a credit, it's a gain. If it's a debit, it's a loss. This is a debit, so I must have a loss on disposal of equipment. What if I sell them? Okay, so here's BTO. We sell equipment that originally cost $16,000, has accumulated depreciation of $12,000, at December 31 of the prior year. It's now March, right? It had accumulated depreciation at 12,000 end of last year. Annual depreciation on the equipment is 4,000 using straight line. The equipment is sold for 3,000 cash. First thing I have to do, I have to bring the depreciation up to date. It's March 31. Annual depreciation is 4,000, and 3 months of the year are gone. I take 4,000 times that 3/12. I need to depreciate another $1,000. So I update my depreciation. What is accumulated depreciation now? It was 12,000. I just added another 1,000 in. Okay. Now I've got to dispose of the asset. I've got to record the sale. First step is to book the cash. Why? Because I know the cash. I'm really good at knowing cash. I sold it for 3,000. That means cash has a debit of 3,000. Then I take the accumulated depreciation off the books with the debit. There it is, 13,000. Then I take the equipment off the books, and it was 16,000. And obviously, because my book value is 3,000, I have no gain or loss, right? I don't need a plug number, so I'm done. Same one, except now I sell it for 2,500 in cash. Bring the depreciation up to par. I get cash of 2,500. Take the accumulated depreciation off the books, take the equipment off the books, and I need a $500 debit to make it all work. If it's a debit, it's a loss. It's that simple. It doesn't have to be hard, but you have to get the semantics of this kind of in your brain. You've got to see how it works. And really what you have to think about is, how did I ever get it on the books to begin with? That's how you have to believe in that. All right, let's talk about natural resources. Natural resources are those things that are either hidden in the ground or maybe they're above the ground, but they're extracted from the natural environment, okay? The total cost of natural resources is any exploration, any research and development, anything that we did to kind of figure out that natural resource so that we could use it up. Oil, coal, gold, any type of mineral that we can get out of the earth. What about timber? Right? So if we can get lumber off of land as well. It works exactly like units of production. I mean, it's that simple. It works just like units of production. Here's a mineral deposit with an estimated 250,000 tons of available ore. That's what we think, estimated, right? Nobody can ever tell you exactly how many tons of ore are in the ground. All of the best geotechnical surveyors in the world can never get this number exact. It's a guess. We purchased this mineral deposit for $500,000 and we expect no salvage value at all. It means we're going to strip the whole thing. The first thing we have to do is figure out depletion per unit. Well, we kind of know how to do this. Cost minus salvage value over now the total units of capacity. If this were units of production, it would have been expected production. It's kind of the same thing. We take the 500,000 divided by 250,000 tons, and it tells us that our depletion per unit is $2 per ton. Well, it's just what we paid, right? If we estimate there's 250,000 tons in the ground, and we bought it for $500,000, we paid $2 per ton. I mean, that's what that is. How do we then deplete it? When we're told what has been extracted, when somebody says, okay, we took out 170,000 tons, right? Or sorry, we took out 85,000 tons. Here's the example down here, sorry. If we took out 85,000 tons and it cost us $2 per ton, then you've depleted $170,000 of your 500,000. And we push it to depletion expense. We have accumulated depletion on the mineral deposit. What happens when my accumulated depletion hits 500,000? We have to stop. You can't go any further, right? You can't make that any more than 500,000 no matter what, even if there's more in the ground. You can obviously extract it and sell it, but it's all going to be gravy at that point. It just means that you underestimated. What about the plant assets used in extracting natural resources? Don't be confused that while they might be required to extract the natural resources, those assets are still recorded as equipment. They're not a part of the depletion. Finally, we get into intangible assets. What are they? They're things that you cannot touch. They're non-current assets that have no physical substance at all. Think of the air, right? They often provide exclusive rights or privileges. Their useful life is often difficult to determine without, some kind of guideline. They're usually acquired for operational use. What types of things are intangible assets? We've got patents, copyrights, franchises and licenses, trademarks, goodwill, leaseholds, improvements, and other intangibles. We always record these at current cash equivalent cost, whatever they're worth, right? Including the purchase price, legal fees, and filing fees. And that's going to be the end of chapter 8.